Welcome back to Know Your Numbers. This is topic number 2, which covers expenses. We'll discuss the 2 basic categories of expenses, fixed and variable, talk about the all-important cost of goods sold category, and later there'll be discussion on basic management of expenses. Carol Feliciano is back to help with our presentation. And Carol, understanding and management of expenses is just as important as generating and increasing revenue.
Mm-hmm. Yes, it is, Ross. And it's not something we just want to walk by. Expenses seem to be just expenses, but that is not so, Ross.
Okay, well, why don't you go ahead and get them started?
Okay, so our expenses are going to help us out a lot. Believe it or not, there are 2 different types. There's the variable cost and there's the fixed cost. I'm going to give you quick definitions. Variable costs increase and decrease based on how much you produce. Fixed costs do not change with the amount of sales that you have. And I'm going to let Ross dive right into variable costs. Take it away, Ross.
Okay. The most common variable cost is cost of goods sold, or COGS, as it is sometimes called. And they're the direct costs associated with providing a good or service. They are variable, meaning, as Carol said, they move in lockstep with sales. So think buying food to cook so it can be sold in a restaurant, inventory purchased to resell in a retail store, or in the service industry, the direct labor required to provide a service such as landscaping or lawn mowing. The really important thing to know about this critical expense category is that it's the most manageable of all of a business's expenses and has the largest impact on profitability. Next, we'll take a peek at what this cost might look like in a typical business. Okay, we're looking at a simple profit and loss statement for the Arlington coffee shop here. The cost of goods section has been blown up so we can take a better look at it. Now, each of the income product lines here have separate sales numbers, and there would be a corresponding cost of goods sold line perhaps for each of those sales numbers. But what's important to know is, for example, if product 1 was specialty coffee, there'd be more than just coffee in the cost of goods sold bucket for the specialty coffee sales line. For example, you might have the ingredients as you see here, which would be coffee, but you also have cups, lids, sugar, stir sticks, shipping costs to ship all those things to your business, those types of things. And oftentimes direct payroll, people that serve the coffee, for example, would be included here as well. So it's really important to know that those need to be tracked, and taking this step essentially will allow you to know the true cost of selling coffee to your customers. Almost all cost of goods sold items have these additional costs associated with them. And Carol will now talk about fixed costs.
Thanks, Ross. I don't think you can belabor it enough that when you do your cost of goods sold section, you understand how much does it cost to produce your product. Nice number. So let's go into fixed costs. They are located underneath the cost of goods sold section after the gross margin. And as we look at it, here's an example spread out. This is some of those fixed costs that are typically included. Remember, fixed costs are the cost to operate your business, and they're not dependent on sales or productivity. So they're not likely to go up and down. For instance, we have accounting, advertising, car and truck, insurance, legal and professional services, just to name a few. In this, I would also include, if you're a restaurant, you would have a meals and room tax. And sometimes if you sell different products, you're going to have to pay sales and use tax. And if I might point out, in this section, you talked previously, Ross, about the cost of goods sold and the direct labor to produce that product. Well, underneath the fixed cost expenses area, this would be the overhead that was, so it's managers and also maybe perhaps administrative staff that would be needed to be paid in addition to run the company. So as you can see, they're separated here. And it might take a little bit of work to make that, to make that separation, but it's good information to know. So what shouldn't be included in this fixed cost area? Well, you don't want to include the owner draws if you're a sole proprietor or an LLC. Okay. You also don't want to include taxes that you paid on the profitability of the company, again, if you're sole proprietor or an LLC. An S corp is a different type of entity, and you would receive wages as an owner underneath an S corporation entity type. So that's where your overhead would be listed here underneath fixed costs. So the other thing that wouldn't and shouldn't be included here is the principal payment part of a loan payment. The only part of a loan payment that is put onto onto the expenses, is the interest expense itself. One thing also I want to make note of that is typically missing for small businesses is depreciation. For a small business, you don't have the luxury of having a tax accountant by your side all year long, helping you to accrue and expense depreciation. I mean, you might, and that's an added bonus. But remember, depreciation is the breakdown of capital costs over the life of the equipment. And so, and I also, the way I like to look at it is that it's replacement cost. So it's a true cost that I like to put in there. The other thing that I want you to know about that, it's a lagging number. You don't even get it until January, February, maybe, well, not even, maybe even to the next year. So just keep that in mind. But depreciation is important to notice. And the other thing is that there could be other items that you forgot to include here that perhaps you put on the balance sheet. And it's important to have good bookkeeping and a good bookkeeper who can help you to differentiate what these costs are and whether they go on the balance sheet or on the profit and loss. So take it away from there, Ross.
Thanks, Carol. As mentioned before, management of expenses is as important as generating growing revenue. A very important part of a manager's or owner's job is to constantly look for ways to minimize costs, particularly those that creep up quietly and slowly eat up profits if attention isn't paid to them. So there's some examples here on the slide. Number one, we'll take a look at insurance rates. Simply shopping these every year at renewal can help keep these in line. Okay, experience has shown me that those creep pretty consistently. And it's the same with supplies. Keep your invoices handy and look at them frequently and see if costs aren't starting to creep up. All right. Now, while you can't always control energy pricing, there are generally ways to manage and minimize the overall costs. Check with your VTSBDC advisor about this one. We have expertise available in this area. Finally, payroll and inventory are almost always manageable. Paying strong wages for excellent employees is sound strategy, but a mistake that is often made is hiring someone before you will actually be generating the revenue to pay for him or her. Inventory costs can be managing by only ordering what will be needed to reach projected level of sales. Inventory can also often be ordered for delivery within 24 to 48 hours, eliminating the cost of keeping it on the shelf for an extended period of time. Payroll and inventory management are topics that are more complex than we have time to drill down into here. The idea is to make you aware that they can be effectively managed with awareness and education, and to seek out help with the fine tuning of it if you need to. You will be more profitable if you do. Okay, Carol, next. Any final thoughts or takeaways here?
Well, Ross, I think what we just learned here is the 3 sections of the profit and loss. And we learned about what is missing and what needs to be included in your revenue and your expenses. And I want to make note that it's just a portion of what we need to learn for profitability. What is your takeaway from this, Ross?
Well, I would love to reemphasize the cost of goods sold and the importance of paying attention to details on those cost items. Details matter. Costs there can creep, and we can talk. You can go on for, I don't know, all kinds of time. A couple of my colleagues delivered a 90-minute presentation on cost of goods sold management, and you would be stunned at the things that you have to pay attention to in order to save your business money. In short, details matter, and not paying attention to those items is basically your business can die the death of 1,000 tiny cuts if they don't pay attention to them. So that would be my takeaway on this one. So for next time, we'll begin looking at financial statements, starting with the profit and loss statement. We'll see you then.